You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning in to the Millionacres Podcast. We've talked a lot on this podcast about investing in real estate deals, because that's what we love to talk about. But today we're going to talk about deal structuring, which we haven't talked as much about. And so who better to ask than a lawyer? Daniel Cocca is a lawyer, entrepreneur, real estate investor, and a co-founder at Alpha Investing. And so he's a New York City corporate lawyer, but he's now a managing director and principal at Alpha Investing, and he's capitalized over $3 billion of acquisitions over the past 6 years. Welcome.
Thanks for having me, Deirdre. Happy to be here. I'll put my lawyer hat on, which I seldom wear for this conversation.
You wear a lot of hats. I think that's good. So yeah, let's talk a little bit about your lawyer hat. So you were an attorney for startups, which I think is really exciting. Probably a lot of drama involved in that. How should real estate entrepreneurs starting out think about their first legal steps? Is it like get an LLC or an S corp before you even begin?
So the process of actually incorporating or forming a company is so simple. You can do it yourself. You could use one of these services you probably see advertised. If you do it in a state like Delaware, you could probably do it in 20 or 30 minutes. And so I always tell people, wait until you've done the work of getting everything lined up, right? The people that are going to be involved, how you're going to engage, what have you, and then go through the process of incorporating. And it's not necessarily because it saves you the $200 or $300 that it costs to go through that process. It's more so if you create something and then you don't use it, then you have to, get rid of it, and you have got to deal with the tax, filings for it. It's a hassle, right? So wait until you're ready, figure everything out, and then it's really simple thereafter. The only thing I would tell people to make sure they have done in advance, especially if they have partners, or I guess only if they have partners, would be get your operating agreement in place, right? Make sure that everyone understands the terms upon which you're going to agree or agree to be in business together, and make sure that's done right up front.
That is a really good point. Something I ran into it in my past. And I think structuring the operating agreement can at times be far more complicated than structuring the LLC. Has that been some of your experience?
Yeah, absolutely. The challenge with whenever you're structuring an operating agreement, drafting operating agreement, you're going to have a bunch of different parties, and they want different things in theory. But even if they want the same thing, they haven't thought about all of the potential eventualities, right? Well, what happens if X happens? Then, Y? Well, Y doesn't help me in the same way it helps you, so we've got to create some type of carve out. And as you continue, kind of down that path, you realize that there are, a lot of very specific terms in these operating agreements that, people need to think about before they start moving forward in a business.
Well, I think it's sort of like a prenuptial agreement. Nobody wants to think about the eventualities of what happens if we disagree, if it goes wrong. There's so much that can go wrong, and yet it's really important to address that. And I think it's important to address that too when it comes to deal structure, anything like that. I think that do you feel that it's the job of the person kind of structuring the deal to kind of inform the other people about all the things that could go wrong?
Yeah, I mean, I think it depends on the business, right? And if we're talking specifically about, a real estate company or an entity that's designed to buy and hold real estate, then I think you and your partners need to have, a path that works for everyone. And, that will vary depending on who you are, what your partners look like, how much capital you have, what the deal's like. There is a lot of nuance to how these things are ultimately structured, right? If you're talking just about, hey, I'm a real estate owner and I'm going to have some investors in my deal, but I'm the manager, right? Then that looks a little bit different than if we have, what are effectively co-managers.
Yeah, I think that part particularly is interesting when you're dealing with limited partners and things like that. What should people keep in mind if they're even trying to think about doing something like that?
Yeah, so I think as an investor, an important thing to keep in mind is that 99% of the time, you're effectively a term taker, right? You're not going to have the influence over the transaction. Now, maybe you're the sole LP in the deal, or you're writing such a substantial check that maybe you do have the ability to negotiate terms like we would when we invest into a deal. But most folks, especially if you're investing into a syndication, you're a term taker. And so what you want to do is make sure that you're looking at the big picture things, and it's transparency. Are there restrictions on affiliate transactions and fees getting paid out? How do I make sure that this group I'm working with is operating in good faith, what have you? One of the things that, one of the terms that you'll sometimes see, which bothers me more than anything, is this whole idea of a catch-up. And so like if your investors aren't familiar with, or your listeners rather aren't familiar with like a catch-up, when you see these waterfall splits in documents and someone says, you're getting a 70-30 over an 8, what people think, because this is how it's marketed and disclosed to them, is that, they get the first 8% and then thereafter it gets split 70-30. But the reason this bothers me so much is that there are a lot of groups, specifically recently, those that are kind of targeting the retail investor, who add this idea of a catch-up. And so basically what that means is that rather than splitting 70-30 after an 8, once you hit the 8, the GP or the sponsor, they're entitled to catch up. So basically, once you pass the 8, you're splitting 70-30 on everything, not just what's above the 8. And that's something that actually bothers me a lot, just because of the way it's never marketed that way, right? When you see a deal and you see terms, you see the 70-30 over an 8, you really have to take a deep dive into what can often be very complicated, real estate entity operating agreements, tons of defined terms. You have to follow, through the document like a maze. And so that's a very long way of saying that, I think it's important investors both understand that they are likely not going to have the ability to negotiate terms, but then go in, review these documents, and look for the 5 or 6 things that actually matter, and make sure that the incentives between both parties are aligned.
Yeah, I think that's so important. And I haven't heard the word term taker before, but I like that because it drives home that idea in that you are accepting the terms. One of the things I think that I've heard from investors is you get that document and it's like 30 pages and it's overwhelming. You don't really know what you're looking for. One of the things I think, maybe makes sense for people sometimes is to just sort of like map it out yourself, almost on a piece of paper, to understand the waterfall. Why is the waterfall always so confusing? It just seems like it's structured in a way that it tends to really confuse a lot of investors.
Yeah, listen, lawyers get paid, $700-800 an hour, sometimes more in major cities, and they create complicated agreements to reflect that. Personally, I don't believe that operating agreements need to be as complicated or hard to understand as they typically are, but that's the reality of the world that we look in, right? And we will often have investors reach out to us and say, hey, I'm talking about a hypothetical, $100,000 investment, and these are the distributable cash, and I want to understand, exactly what's going to come to me and what's going to go to the sponsor partner, what's going to go to you guys, and that's a helpful exercise, to understand it all, right? Or, alternatively, you have someone in the middle who's kind of playing that role that you trust. I think, whenever you're making an investment into any type of private transaction, but especially real estate, first and foremost, you need to trust the partner that you're working with and that you're giving your capital to. If you ever find yourself in a situation where you need to enforce an operating agreement or a contract as an investor, you've already lost, right? You're going to spend hundreds of hours, probably years of your life, and hundreds of thousands of dollars trying to recoup those losses. It's a very challenging thing to do. And so finding good partners, the most important part of this process.
Yeah, I would agree with that. So your company, you specialize in private placement, institutional quality real estate deals. Let's break that down. So institutional quality means things that likely aren't offered to retail investors. What is the private placement aspect? Is this for accredited investors only?
Yeah, so we're doing, real estate private equity, right? And the reason why, really across the industry we talk about it as quote unquote private equity is because these are not deals that are being registered with the SEC, right? So in my prior life as a lawyer in New York, I first started working on capital markets transactions. So, bond offerings, IPOs, what have you. And even in that space, most transactions are unregistered deals. The difference, though, is that they very closely follow the SEC rules for what a registered deal would have to have. They just don't go through the SEC review process, which takes a very long time. And so when we talk about private, it's, hey, investor beware, these deals have not been signed off on by the SEC or any regulatory agency. And so, you need to evaluate them, with that in mind ultimately, right? And so that's when we talk about private, that's ultimately what we mean.
Interesting. So that idea of registered versus unregistered, it does seem, one of the things I'm noticing right now is it's starting to get really, really frothy in terms of private capital kind of going everywhere. I'm seeing more and more investing platforms crop up. Do you think that the SEC is going to start getting a little bit more involved in some of this?
I do. And I've been saying this since I started in this space in 2015. One of the biggest shocks for me coming from, a law firm that put together these 150-page, investment documents for every transaction was how different the marketing disclosure process was in real estate private equity. And the reality is, there are groups that do what I would call a good job, which is they put together this 30 or 40-page document. They give you the diligence rooms. They let you take a deep dive into whatever. But there are also groups that might just show you 3 or 4 pages, what's kind of an executive summary, and you make your investment decision based on that. And that's a little bit more problematic in my mind. And I guess I should also qualify to say, I generally have an investor protection mindset when it comes to these types of things, regardless of whether you're an accredited investor or not. It's just a really challenging, again, as a term taker, you're not in a position where you can, force a partner to give you information that isn't already available, right? And so at the end of the day, I just think it's important that people understand that element of how these transactions work. You're going to get a document, you're going to have to make an investment decision. If you're not comfortable with the information that's provided, you have questions, you should ask them. If you don't get those answers, it's probably a deal you should pass on. In this present moment in time, there's a lot of FOMO in real estate investing, right? Like everyone wants to be in these deals that have just been crushing it because of cap rate compression. But the reality is, like the space in a lot of ways is the wild, wild west, and it's going to change over time. I think because we've been a part of this like massive bull run in real estate, really dating back to 2010, but especially over the last 5 to 6 years, these problems that come out when deals don't perform, or that's only when these problems, expose themselves to the world. But, I'll tell you, there's a deal that I invested in that, it missed its underwriting projections of net operating income by 40%, but it still, got us a 35% IRR because cap rates have compressed so tremendously over the last 3 years that every deal is getting bailed out. That will, of course, change as cap rates are incredibly low. And I think as more, kind of they say in the SEC world, sunshine is the best disinfectant, right? So the more deals that are brought to light, the more deals that go bad for reasons that lawyers look at and say, this is problematic, I think that's going to spark a lot of regulation in the industry.
Yeah, I think that's true. And what you mentioned there is a really good point for investors, I think, to keep in mind is that this has been a market in which it's almost hard to lose because prices have been going up so much. And the other thing I think about is the length of this cycle. We're in a cycle that has gone on longer than most historical cycles, and it's gotten to the point, I think, where some of the investors who are investing now may not have the knowledge of what it's like when prices don't go up like this, because real estate is not always up. I mean, it's up over time, absolutely, but I think we're in a very unusual cycle. Is that something that concerns you at all?
It is. I don't have a crystal ball. I don't pretend to have a crystal ball about what's going to happen in the future. If I did, I would have smashed it in 2015 when I said we need to get into long-term fixed rate debt and and what have you. And so that's a story for another day. But at the end of the day, I think it's important to understand that you're putting your capital at risk. There's no guarantee that you're going to earn money. And it's important to understand how these deals work. At the end of the day, like these underwriting models and financial statements, you can look at them, and if you can understand, really one thing, is this business plan that we're trying to achieve feasible? And if so, if we're conservative on our sale multiple prices, our exit cap rate, you can get pretty comfortable, that a deal is going to make sense. You can probably get 60 or 70% of the way there. And then there's, of course, a ton of time that we spend on just looking at the specific line items, whether it's a utility expense or taxes. If you're investing in Texas, for example, you really have to think about the assessments that occur at sale and how that impacts your taxes. That can basically wipe out all your cash flow if you're off on those numbers. And so just a long way of saying there are a lot of things to think about. But personally, I would think we have maybe 3 to 5 more, strong years ahead of us, but we're going to hit an inflection point relatively soon as this taper wears off, I think in July of next year. And, we start to see interest rates rise, right? That's an inevitability that they're going to rise. It's a question of what happens when they rise. Typically, interest rates and cap rates go the same direction. So interest rates go up, the cost of borrowing is higher, and therefore you are willing to pay less for an asset than you were in a lower interest rate environment, right? But what we had seen, kind of leading up to this moment in time, particularly pre-COVID, is that really wasn't happening, right? Interest rates were going up and cap rates were continuing to go down, right? And so the thesis or the thinking around why that's been true is there's just so much new capital into real estate, tons of record amounts of private equity dry powder, and that capital needs a place to go. And even if yields aren't going to be you're not going to get a 15 IRR on a transaction, people are still happy to deploy their capital into real estate. And so I think that's going to be something that people should really take a look at, is what happens to pricing as interest rates rise. You'll hear tons of arguments on both sides of the table, and so stay tuned.
Yeah, definitely. One of the that you talked about right there is the taper, and that's the tapering of the bond buying that the government has been doing. Let's talk a little bit about that and how that impacts the world of real estate.
Yeah, so I think a really important thing to understand is that there's been a record amount of capital added into the system, really since 2008, 2009, right? And what we saw for a very long period of time, really only up until the last few months, was a lot of asset level appreciation, right? But not a ton of consumer price inflation. And for most people, they care much more about consumer prices changing. I was going to go on vacation and it was going to cost $5,000 and now it's going to cost $6,000. That's something that people care about more than what the cost of an apartment building is, right? And what happens, even if that capital, as it gets put into the system, first goes into the hands of the people who need it most, eventually it works its way back to the wealthy. And the wealthy, who are not impacted at all by nominal changes in the consumer price index and the cost of goods, what have you, they've been dumping all that money into assets, right? And so asset prices have been going up year after year after year after year. What we're seeing now, and I think last month, inflation year over year for consumer products was like a little over 6%, something like that. That's starting to creep in now. And so, the question on a going forward basis is like, well, what does the world look like, 2, 3, 5, 10 years from now? Are we going to have rampant inflation? In which case, it's very important that anyone who can be an asset owner is an asset owner. Those are the folks who benefit the most in an inflationary environment. As we know, unfortunately, most people are living, paycheck to paycheck and really aren't in a position to be asset owners. And that's where I think we run into larger societal issues around, the disappearance of the middle class and income gap, what have you. And so I'll get off my soapbox now, but I think that's a really important thing to keep on your radar.
Yeah, I think that's important too. It's something we thought a lot about at Million Acres as well. Well, let's talk a little bit about what you do with alpha investing. One of the things I liked on your website was you said that, a lot of people in the crowdfunding business in general are in the business of talking about how many deals they say no to. And you said that you like to start sponsor first. And I think that's really interesting, but it also makes me wonder how sponsors get in the game when there's so much focus on track record.
That's a great question that I don't have a great answer for someone who's looking to become a new sponsor. Because the reality is, at least for a group like us, there's almost no circumstance where we would invest with what you'll call a new sponsor. There is a world where someone was the head of acquisitions at a big real estate private equity firm and they're going out on their own, and we would consider investing with them, but only after they had acquired, a few $100 million of properties, right? That's the challenge in this space. And it's not just because of the experience element. And I'll tell you an example. The worst deal that I ever invested in, right, was a new sponsorship. The group had 2 or 3 properties under their belt at that time, but it was 2 25-year plus veterans of a very large, very well-known New York City-based REIT, right? And they got into a project. It started out well, but then what happened, and this was like in the 2017 range, we had 7 out of 8 consecutive quarters had rate hikes. And we were in a floating rate debt piece. And we got to a point where this group really needed to refinance that loan. But as individuals, they didn't have the net worth, even though they were, long-term real estate professionals, to renegotiate the debt terms in a way that made sense for the deal, right? And so that's a very long way of saying, even if you're great at executing, there are circumstances that can change in these transactions, and you need to be investing with a group that has already shown an ability to navigate those changing circumstances. And that's always the biggest challenge for me because, when you try to go out and get debt terms that make sense, if you're a person or a group that just doesn't have the requisite net worth or the right lender relationships, you're going to find it very challenging, especially in certain debt environments, to execute on that strategy. And as we know, that's where you can actually get into trouble in terms of losing principal on a transaction, is when you get to a point where you can't cover your debt service anymore, right? And so on that deal, fortunately the group sold out of it and everyone basically got their money back. So, no lost principal, but that was setting up to be a disaster. And so, just a long way of saying, I think if you want to get started, the path is learn how to do it from other people and get yourself into a position where you can understand the business, and then build equity relationships over that time, so that when you do go out on your own, maybe the first 1, 2, 3, 4 deals, you're not the GP manager and everyone else is LPs. Maybe everyone shares equally, right? Maybe you're not going to take a promote. You're going to put your money into the deal along with your partners, and you're going to build a track record, get your experience before you go out and enter into these more market-like GP LP structures where you're making your money based on the performance-based fee. I think that's probably the way that, as a new sponsor, you can mitigate some of the risks, or at least the optic of risk, to your investors.
That is really, really solid advice. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Have you realized capital gains this year? You can receive a tax break on your capital gains if you reinvest them in the Origin QOZ Fund 2, a private real estate investment that will be a diversified portfolio of ground-up multifamily developments. Some examples of assets that can be sold and the proceeds reinvested in the QOZ Fund are stocks, real estate, a private business, cryptocurrencies, and art. If you reinvest your capital gains in the QOZ fund, you can receive major tax benefits. In fact, an investment in the Origin's QOZ fund can even boost your after-tax real estate returns by more than 75% as compared to a non-QOZ investment in similar properties. QOZ Fund 2 is offered by Origin Investments, a top decile fund manager who has executed more than $2.6 billion of real estate deals. Their first QOZ fund closed in July of 2021 after raising more than $265 million from over 800 investors. Go to origininvestments.com/millionacres to learn more about tax benefits of the QOZ program and to download your fund overview today.
I'm back with Daniel Cocca, and we're talking about the legal side of real estate deals. So let's talk a little bit about holding capital, gathering capital. So if you're a sponsor or you're putting together a deal, what are the rules around that? Is there a legal aspect to that?
Yeah, so when you're going to collect money from your investors, you're most likely going to do it in advance because you don't want to be scrambling the day you're closing, right? And you're going to put that money into an escrow account. And I think really the only rule, and this is the golden rule, is do not touch that money except when you send it to whoever it is you're buying the property from, right? It's very easy, I imagine, and probably a very slippery slope to say, hey, I've got $1 million in an escrow account. I have a deal closing in 2 weeks, and I really need $50K to float into another project that I'm working on. Like, I'll just do that. And then when that other deal sells in 2 weeks, I'll backfill it and it won't be an issue, right? And you're building a house of cards, right? And the challenge is, even if you didn't have, bad intentions, you didn't intend to steal money, when that other deal doesn't sell for whatever reason, you're now in a really tough spot because, you owe money to an entity that you don't have. And so then you're going to scramble. And long story short, keep the money in the escrow account until it goes to the seller of the property, and you'll have no issues.
Yeah, that's definitely true. When I was taking my real estate exam, they kind of drilled that into our heads about commingling and things like that. So when you're putting together a real estate deal, there's a lot of information. We talked a little bit about the waterfall and the deal structure. Does every deal need to have a waterfall like that? And how does mezzanine financing figure into that? I think that's one of the parts that people find a little confusing.
You don't need to have a waterfall, but the waterfall is, the kind of market way that these transactions work from a flow of capital perspective, right? Two consenting parties can agree to whatever they want to agree to, right? You could say, I'm going to give you my money and I want, a 7% return, and that's all I want, right? And it could look more like debt in practice or mezzanine or pref equity, right? And you're seeing a lot of folks use pref equity because it gives them a way to add incremental leverage to a project, right? And so maybe you go out to a traditional lender and you get, a 70, 75%, kind of LTV loan, right? But you think you can juice the returns a bit if you could have an extra, 10% of leverage. And so you add on this pref equity piece and you pay the pref equity piece, a much higher interest rate, sometimes north of 10%. But they're now in a senior position to the common equity holders. And it's something that under the right circumstances with the right group, maybe I could get comfortable with, but I don't ever want to be, as a common equity holder, you're already in the first loss position, meaning, if capital is lost, it comes out of your pocket first. And, only after the first lien debt holder and the second lien or the pref equity, they get their capital back, do you then see, return of your capital or potentially upside, right? And so I think, it can be dangerous if it's being used, solely to juice returns because, additional leverage wouldn't otherwise be available for that type of project, right? And so that's how I tend to think about it. Again, that's not to say there can't be a situation where pref equity, there are a few deals we've invested with over the years where, adding the pref equity piece was actually accretive to the returns and we still had the same level of downside protection. I think in that case, some financial engineering to create a structure like that can certainly make sense. But it is something as a common equity holder in the first loss position that I would be very wary of.
Do you also do, or have you seen capital calls being used on investments? I know that we've seen a little bit of that in the hospitality sector, sort of when the pandemic hit. Is that something that you're seeing more of, or as deals kind of linger on a little bit?
So every operating agreement is going to address the idea of a capital call, and they're all going to say a capital call may occur, and if it does, these are the conditions upon which it happens. So, you need to put in additional money, and if you don't, usually two things happen. You either get diluted, where there's now more capital in the deal, and so your ownership percentage is less, or worst case, there's some type of penalty, right? If you don't put your money in, then you're being diluted with a multiple because we needed that capital for the deal. Now, we've actually never been in a project that has needed to have a capital call. It can happen in a number of situations, but you really find two situations are most likely. One is where maybe there's an adjacent parcel to the property that you purchased, and it could be developed, and it makes sense to develop it. And the sponsor comes back to the LPs and says, hey, if you all want to put an extra, $15,000 into this deal, we can go out and actually build this property and create more value for everyone else. It's effectively a new investment, right? Those capital calls can make sense. Again, if you understand up front that that's what's happening, and then two, if you're not penalized if you don't participate, right? The more challenging situation is one where maybe you run into it's 2017, 2018, you've got floating rate debt, rates are ticking up, and all of a sudden you can't cover your debt, right? Someone's got to find capital to make sure you all don't lose the property. Or you thought you were going to be able to renovate the property for $2.5 million, but because of COVID, supply chains are constrained, prices are going up. Now you need $3.5 million, and so you got to go back out to investors to get the rest, or you can't execute on your business plan. Those are obviously more problematic capital call scenarios from the investor perspective, but there are really two boxes that they can fall into.
Okay, you mentioned supply chain. How much is that worrying you when it comes to completing properties, things that are, opportunistic or something like that? And is labor also something you're kind of factoring in? Because I know the amount of construction jobs, it almost got evened out during COVID, but now, of course, there's hundreds of thousands of jobs in construction that aren't filled.
Yep, and every asset class has different things that matter or can move the needle, right? So in senior housing, for example, assisted living, memory care facilities, where it's very operationally intensive, the COVID issue hasn't been necessarily deaths or cases at these facilities, although that's obviously been problematic. It's that the labor costs have gone up tremendously. And when you have 25 or 30 employees at a senior housing facility, which is probably 5x what you'd have at a multifamily apartment building, those costs can start to get out of control, and that can have a major impact on cash flow that's available to be distributed to investors. And then, in a multifamily deal, it's like a value add deal, for example. We have heard a lot of stories of materials being delayed, whether it's appliances or hardwood floors or lumber prices have gone up. And what that does is it just changes your return on cost, right? If you thought that you're going to spend X dollars and get Y return, now you're spending X plus some other number and still likely getting Y return. And so your return on cost is a bit lower than it otherwise was. The group that we partner with who has done the best job at this, right before COVID, they took their own money, not investor money, out of their own pockets, and they bought 2 years worth of renovation supplies. So the hardwood floors, the subway tile backsplashes, the quartz countertops, the appliances, and they bought massive storage facilities in the 3 cities they operate in, and they kept it there. And there's been no downtick in their renovation timeline, which is something that's really important in a value add deal. You're right. You want to churn through those units, really as quickly as you can. There hasn't been an issue getting supplies, but we are hearing anecdotally that, renovations either slowed down during COVID or stopped entirely. Supplies are not necessarily getting there in time. And so there are delays. And that's problematic because the way that the underwriting typically works for these types of deals is that you're getting an exponential return. And so I guess to be clear, what I mean by that is if we say, hey, we're going to increase net operating income by 4% in year one and 8% in year two, right? But because of COVID or something else, in year one, instead of being at 4%, you're at 0%. Well, it's really hard to catch up in year two, right? Because now you've got to hit that 12, 15% in year two just to get back to where you project it to be. And so, managing for these variables is a really important part of the role that the sponsor operating partner plays in these transactions, right? There's, I think a president at some point in history said there are, not known unknowns and like unknown unknowns, right? And you got to make sure that you understand how to navigate the known unknowns. There's got to be a plan, and some supply constraints, whether it was, the result of COVID or anything else, has to be something that the partners you're working with are thinking about.
Yeah, well, let's talk about one of those I guess it's a known unknown, which would be our current inflationary environment. And rent prices have gone way, way up. The price of everything has gone upward in a very inflationary situation, which is very strange because we haven't had this type of inflation in decades. How does that impact your business?
Yeah, so it's something you have to take into consideration with really any investment decision that you're making, right? And, as I said before, I think it's really important for people who are able to be asset owners, right? Because when you're an asset owner, you get the upside of the inflation, right? Whereas if you're sitting in cash, your money is effectively, losing value, right? Now, what happens with interest rates and cap rates, as we talked about before, is going to be, really important here. If you asked me personally, I would love for for cap rates to rise maybe 50 bips, across asset classes, in a vacuum, so to speak, because I think that creates an environment where, the deals that you're invested in today are still going to perform very well, assuming, that deal execution was there, right? But then on a going forward basis, as you look to actually acquire new properties, they're not quite as expensive as they are today. Because what you're seeing, especially in like the value add workforce multifamily space, cap rates are getting very, very, very low. Like, cap rates we never thought we would see, sub 3% in some of these, gateway markets. That's the regular now. And, for a value add deal, buyers are willing to pay more in a vacuum for a deal where they can create actual value at the property, right? Because when they sell that property, assuming the cap rates are still low and there's still maybe some meat on the bone in terms of the value add opportunity, you're going to get to sell that to the next value add buyer at a lower cap rate than you would a stabilized property. And that value that you create, the improvement you make to NOI, you're getting a much higher multiple on it, right? At a 5 cap, right, you're getting a 20x on net operating income. At a 3 cap, you're getting a 33x, right? And so it changes the equation. But the secondary challenge, and this is probably something you should think about actually as your primary consideration, is that the downside protection changes, right? When you're buying a deal at a 3 cap, your margin for error is substantially lower than it is when you're buying a 4.5 or a 5 cap. And I think what a lot of people in our space talk about is, well, what do value add deals look like in 2-3 years if this trend continues? And I think the idea is they'll probably look a lot like development deals, where you'll acquire a property, there will be no cash flow for the first 1 or 2 years at least, and the bet you're making is on the residual value, at the time the renovations are complete and the asset is ultimately sold, right? And, most people who invest in acquisitions like us got into it because they like the idea of cash flow, not just because they want to put money in their pocket in a tax advantageous way, but it's also a risk mitigator, right? If you're putting cash in your pocket, there's yield to be distributed. That's a good sign that, you're not going to lose your principal because you can't pay your debt, right? And so it's a very long way of saying, what happens in terms of asset level inflation, can be good or bad for owners or buyers, but everyone's got to be aware of what's happening. You've got to navigate accordingly.
Interesting. So I know that your firm is invested in multifamily. We touched a little bit on senior housing. What are you thinking about geography right now? We saw last year migration, Sunbelt migration, which was happening before, but Phoenix, everyone went there. Austin, Texas, booming. And prices, it's very hard to be an investor in the hot markets right now. What are you thinking about geography?
Yeah, it's a really good question. And our strategy in multifamily, I think, falls into 2 buckets. One are the deals in those gateway markets like a Phoenix, Vegas, Austin, for example, right? And the story there is really about value creation and upward, rent prices, right? What we've heard from a lot of our partners is that, in an effort to get people to terminate their leases or rather not renew their leases, they'll give them a 20% rent bump without doing any renovations with the expectation that, hey, no reasonable person is going to accept the 20% rent bump with no improvements to their property. But there's so much upward rent pressure across the entire market that they really don't have a choice, right? And so, that's in those types of environments. I feel bad for the folks that are in some of these workforce housing facilities, right? Because they just don't have any negotiating power, and they're subject to what's happening in the market. And the challenge is that as all of these institutions, buy up all of these assets, there's really nowhere for these folks to go. And meanwhile, single family homes, like the affordable ones, are, getting shot up in price as well. And for new builds, no one is building entry-level homes, right? I think if you look back to like the 80s, entry-level homes were like 40% of what was being built in any given year. Now I think it's like sub 4 or 5%, right? And so it's a very challenging dynamic to, again, not be an asset owner, but a renter, whether it's, apartments or homes. And so in those types of markets, we look for that value creation opportunity. Where can we come in, create a better product than was there, increase rents, together with that better product, and then ultimately, we'll exit those deals, hopefully having improved NOI. And we usually underwrite deals to have about 200 basis points of cap rate expansion, and so we would never expect that to happen in any given deal. But if a deal can make sense, it can get you that mid-teens IRR. Assuming that happens, then we feel pretty comfortable in an environment where cap rates, stay even or maybe even, increase by, 50 bips. You're still comfortable with the return you're getting. You're still outperforming, your underwriting projections. And then on the other end of the spectrum, I think what's interesting to us as well are these like smaller secondary markets, stable tertiary markets where you can buy these sub 150 unit apartment buildings, because you don't see 400 unit apartment buildings in Franklin, Ohio, for example, right? They're going to be smaller properties, smaller units, but you can buy these at 5, 5.25, 5.5 caps. And as we talked about before, that gives you a lot more margin for error. And rather than, increasing rents by $250 or $300, maybe you're only trying to increase them by $75 to $100, and you're not spending $20,000 per unit renovating the property. Maybe you're spending $5,000 to $7,000, right? Those deals can make a ton of sense as well. And like anything in investing, especially real estate, what you see is the institutional capital chases the yield, right? It wasn't all that long ago, the early 90s, where multifamily was not seen as an institutional asset class, right? And that's obviously changed dramatically. And especially as we've seen performance during COVID, so much capital has flown into that space. Yields are compressing across the board. If I had to make a bet, my thought is that these higher cap rate markets, the smaller secondary and tertiary markets, they're the ones that still have the potential to see greater cap rate compression on a going forward basis. Now, that could, of course, be proven wrong, and we'll find out. It's hard for me to believe that people are going to be buying 1980s apartment buildings in Phoenix at 2 caps, but if we had this conversation in a year, like we might be surprised.
The garden style apartment boom, people buying up those old assets, has been really fascinating to me. And you mentioned, multifamily becoming an asset class. Now we've got single family rentals becoming an asset class, and that's becoming, a much larger part of the market. Well, let's talk a little bit as we wrap up about your company and what you're doing. How long are the holds on these deals, and what is the minimum investment?
Yeah, so we typically underwrite deals for 3 to 5 year holds, give or take. One of the challenges with underwriting, and this goes back to my days as like a lawyer who's focused on disclosure, you never market like let's take a bond deal, for example, or an IPO. You're never marketing those deals to investors based on forward-looking information, right? As a lawyer, you say, absolutely not, nothing forward-looking, like let's pretend the future doesn't exist. Let's only look at trailing financial data and what you've done, and people can extrapolate what you're going to do in the future. But, we're not telling them anything's going to happen. Whereas real estate's like almost the exact opposite, where you have your trailing financial data, but it's all about the forward-looking projections, right? And they're all based on a set of underlying assumptions, which may or may not be valid, right? And it's very easy for someone to create a deal or a structure that they think makes sense on paper or pencils to a certain number and is therefore attractive to investors, right? I mean, in a vacuum, if I showed you a 20 IRR deal or a 12 IRR deal, I know definitively that the majority of people will choose the 20, right? And they do that because they assume, well, even if it doesn't hit the 20, like it'll still be better than a 12. And the reality is like, no, if it doesn't hit the 20, if the deal doesn't perform, you may be in a scenario where you're looking at low single digits, maybe a loss of your principal even. And so, people have to understand kind of what is happening in the space and how these deals are ultimately put together. And I've just gone on a tangent and like forgot the first part of your question. This is something that I'm like, I love to talk about because it's one of those things I hate so much about the space. But let me stop.
No, you hit on something that we've talked about so much with Mogul too. Is like people get so IRR crazy that they forget to look at anything else. So no, I love that. The other half of the question was minimum investment.
Yeah, so our minimum is $50,000 for our deals. The intention is for us to still be accessible. The one thing that we're a little bit different though, like we don't fall into the crowdfunding bucket per se. We've capped our network at about 1,000 investors. And I think right now there's maybe like 875, maybe 900 active people in the network. And whenever we tell people that we're not admitting 90% of the new people who request access, and we've got this 1,000-person wait list, I think you're crazy. Like you're turning away investors. And the reality is, like when we started Alpha, we were busy working professionals, and we were trying to find a way to invest into institutional, quality private real estate in a way that made sense for individuals. And until very recently, until the Jobs Act, that was something that was very challenging to do, right? People had to do the country club, the friends and family. You typically invested with smaller, more local operators because you just couldn't write, even if you could write a 7-figure check, that's not going to do the trick with these, groups that have billion-dollar portfolios, right? They want 10, 15, 20, $50 million checks, into their funds. That's how you participate. And so the whole space has changed, very dramatically. But from our perspective, we always wanted to be in a position where the people who kind of put their faith in us as we started, they weren't going to get pushed out of these deals as the firm grew and, new capital came in, and that new capital was writing larger checks per deal than the old capital. And so, we've kind of capped the network to make sure that everyone who's part of what we're doing will have the ability to participate, in perpetuity, hopefully, right? Because if you have 10,000 people and everyone's competing for deals, and you see this all the time, right? A deal goes up within a few hours, it's fully subscribed. You have this amazing time pressure. You got to pull the trigger in 3 hours. I can't underwrite a deal in 3 hours. I don't think someone who's a kind of casual real estate investor can do it. And so it's just a long way of saying it's really important to us that we keep the network small and that we have relationships with everyone in it. When you become a member in Alpha, everyone has to speak with one of the founders of the firm before we grant you access to our portal, right? And it's a really important thing that I think a lot of folks overlook, because if you invest in a deal with us, we're going to be in a 3, 5, maybe 7-year relationship. And for us, let's put the time in today. We're willing to do it. You should be willing to do it as well. And let's make sure we're on the same page. Like, I'll tell you about how we think about investing and what you should expect to see from us. And I want to know what you're looking for. Let's make sure it's a match. If you say, I want super high IRR, development deals, I'll tell you we're not going to be a fit. You're not going to see that from us, right? And so I think that's a really important part of the process as well. If we had 10, 15, 20,000 investors in the network, I wouldn't have the time, right? I wouldn't have the time to speak to every person. I wouldn't get to actually understand what the people in our network are looking for, what they care about. And, if we were saying, let's build the largest real estate company ever, I would probably have a different answer to that question, right? But we're building something that's, 10 full-time employees, all, very highly skilled professionals. Like, we don't need to deploy $2 billion a year in order for this to make sense for us, right? We look for 8 to 10, maybe 12 deals a year that we think are going to be real home runs. And those are the projects that we invest with the folks who are in our network.
Interesting. It's a very different perspective than a lot of other companies. I like that a lot. So as we wrap up then, what is the future for the company? Is your goal to kind of keep it that small? Are you trying to think about how to sort of scale without losing that aspect of things?
Yeah, I think that's a really important part of what we're doing is scaling while maintaining the same kind of values and relationships that we have, right? And so, with the network we have today, we can easily deploy, a couple $100 million of equity into projects in any given year, right? And so it's just a matter of continuing to grow and nurture those relationships. And the really good thing that happens for a company that's in the space that we are, let's say you have your deals are on a 5-year hold, right? When these deals start selling, hopefully, let's say you do one a month starting 5 years ago, and then one sells every month thereafter, there's all of this new capital coming into the network if you've done your job properly, right? And so maybe $5 million got invested in January of 2015, but, $12 million came back to people in January of 2020, right? Well, now that $12 million is going to get invested in addition to, whatever new capital is coming in, right? And so it's a system and that kind of builds on itself. And so, I think that's how we think about it. We're trying to, this is very much like a boutique real estate private equity shop, right? We've got our group of people that trust us. We know them, they know us. And we're going to keep doing what we're doing for them and, of course, ourselves because, we're investing in all these deals as well. And that's a more interesting company, business, life for us than, playing that game of constantly trying to bring in new investors and raise new capital and convince people that, you're the best group to invest with. That's just, personally, that's not what we're interested in doing.
I love that. Well, thank you so much for your time today. Reminder to listeners, if you want to learn more, it's alphai.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.